Here's a statistic that will blow you away. The average day trader loses everything within 6 months. Not some of their money, not most of their money, everything. And the ones who make it past that first year, 90% of those are gone by year 3. We're talking about a financial massacre happening in real time, every single trading day, across every market on the planet. But here's what nobody wants to tell you. It's not because the markets are rigged. It's not because you need some secret algorithm or insider information. The reason 90% of traders fail isn't mysterious at all. It's actually painfully obvious once you understand what's really happening behind those red numbers on your screen. Today, I'm going to walk you through the brutal mathematics of why most people who touch a trading account end up broke. More importantly, I'm going to show you exactly what the 10% who survive are doing differently. Because the gap between winning and losing isn't about intelligence or luck. It's about understanding a few critical principles that most traders violate every single day without even realizing it. The uncomfortable truth about trading psychology starts here. Your brain is actively working against you. Evolution wired us for survival in environments that have nothing to do with modern financial markets. When you see your position dropping, your nervous system triggers the same fight or flight response your ancestors felt when facing predators. When you hit a winning streak, the same dopamine pathways that kept humans motivated to hunt and gather start flooding your system with overconfidence. This isn't your fault, but it is your responsibility to fix. Because while your emotions are screaming at you to buy high and sell low, successful traders have learned to do something that feels completely unnatural. They've trained themselves to act opposite to their instincts. Let me paint you a picture of what this looks like in practice. A new trader opens their first position and watches it immediately move against them. Their heart rate spikes. Their palms get sweaty. That little voice in their head starts whispering about all the money they're about to lose. So what do? They hold on, hoping it will turn around. They've just committed the first deadly sin of trading. Meanwhile, an experienced trader in the same situation sees that red number and feels nothing. They planned for this exact scenario before they ever pressed the buy button. Their stop loss was set, their risk was calculated, and when the trade hits their exit point, they close it without hesitation. No emotion, no second guessing, no hoping for a miracle. The difference between these two responses determines everything. One trader is gambling with their feelings, the other is executing a business plan. Guess which one keeps their money? Now let's talk about something that destroys more trading accounts than any single factor. It's called position sizing, and most traders get it catastrophically wrong. They think success in trading means being right about market direction. They couldn't be more mistaken. Success in trading means surviving long enough to be right when it matters. Here's how the math actually works. If you risk 10% of your account on every trade, you only need to lose 10 trades in a row to wipe out everything. Sounds unlikely? It happens every single day. Markets can stay irrational far longer than most traders can stay solvent. But if you risk just 1% per trade, you can lose 50 trades in a row and still have half your account left to work with. Most beginners hear this and think it sounds boring. They want to make serious money fast. They see someone online bragging about turning $1,000 into $10,000 in a week, and they think that's what trading success looks like. What they don't see are the hundreds of traders who tried the same approach and lost everything in the process. The survivors understand something crucial. Trading isn't about hitting home runs, it's about consistently getting on base. You don't need to double your account every month to build real wealth. You just need to avoid the catastrophic losses that send you back to square one. This brings us to one of the most dangerous myths in trading. The idea that you need to be in the market constantly to make money. Most losing traders suffer from what I call action addiction. They can't stand watching price movement without participating. They see every dip as a buying opportunity and every spike as something they're missing out on. But here's what the data shows. The most profitable traders spend the majority of their time doing absolutely nothing. They're watching, analyzing, waiting for their specific setup to appear. When it doesn't meet their criteria, they sit on their hands. When other traders are frantically buying and selling based on every news headline and price tick, successful traders are practicing the hardest skill in all of finance: patience. This isn't laziness, it's strategic discipline. Every trade you don't take is money you don't risk. Every setup you skip because it's not quite right is capital preserved for when the perfect opportunity appears. The market rewards precision, not activity. Think about it this way. A surgeon doesn't operate on every patient who walks through the door. They wait for cases where their specific skills can make a difference. A hunter doesn't shoot at every animal they see. They wait for the right target at the right distance under the right conditions. Trading works exactly the same way. The amateur trader sees his patients as missing opportunities. The professional trader sees it as creating them. But there's something even more destructive than impatience. It's the inability to accept being wrong. Most traders approach the market like they're taking a test where every answer needs to be correct. They enter a position and immediately become emotionally attached to being right about that trade. When the market moves against them, they don't see new information. They see a personal attack on their intelligence. This is where the real carnage begins. Instead of cutting their losses and moving on, they start making up stories. Maybe it's just a temporary pullback. Maybe the big institutions are trying to shake out weak hands. Maybe if they just hold on a little longer, the market will realize they were right all along. Every minute they spend in denial is another minute the market is taking their money. Professional traders have a completely different relationship with being wrong. They expect it. They plan for it. They know that even the best trading systems are wrong 40 to 50% of the time. The difference is they make more money on their winners than they lose on their losers. They've learned that being wrong about individual trades means absolutely nothing as long as they're right about their overall approach. Here's where most people completely misunderstand risk management. They think it's about using stop losses or calculating position sizes. Those are just tools. Real risk management is psychological. It's the ability to take a loss without it affecting your decision making on the next trade. It's the discipline to stick to your system even after 3 losses in a row. It's the emotional strength to stay focused on probabilities instead of getting caught up in individual outcomes. I've seen traders blow up accounts not because they didn't know where to place their stops, but because they couldn't handle the stress of being wrong repeatedly. They start second guessing their system. They begin making impulsive changes. They abandon their plan right before it would have started working. The market didn't beat them. Their own inability to handle uncertainty did. The successful traders I know have all learned the same lesson. They figured out how to divorce their ego from their trades. When a position goes against them, they don't take it personally. They simply execute their exit strategy and look for the next opportunity. When a trade works in their favor, they don't feel like geniuses. They know it was just probability playing out in their favor this time. This emotional detachment isn't natural. It has to be developed through experience and practice. Most traders never get there because they quit after their first few major losses. They assume that successful traders never lose money, so when they inevitably hit a rough patch, they conclude they're not cut out for this business. But here's what they don't understand. Every successful trader has lost money. Lots of it. The difference is they treated those losses as education rather than failure. They studied what went wrong. They adjusted their approach. They came back stronger and more disciplined than before. The market has a way of humbling everyone eventually. You can have the best strategy in the world, but if you can't execute it consistently under pressure, it's worthless. You can understand technical analysis better than most professionals, but if you let your emotions override your rules, you'll still lose money. This is why the most successful traders focus more on themselves than on the markets. They work on their discipline. They practice staying calm under pressure. They develop routines that help them maintain objectivity when everything around them is chaos. They understand that trading is ultimately a game of self-mastery disguised as a financial endeavor. The traders who survive and thrive have learned to treat their trading like a business rather than a hobby or get-rich-quick scheme. They keep detailed records. They analyze their performance regularly. They continuously look for ways to improve their processes. Most importantly, they never stop learning and adapting. They also understand something that destroys most amateur traders. Consistency beats perfection every single time. You don't need to catch every major move or nail every reversal. You just need to execute your edge repeatedly over hundreds or thousands of trades. The profits come from the cumulative effect of small advantages compounded over time. This patient, methodical approach feels boring compared to the excitement of trying to hit trading home runs. But boring is profitable. Excitement is expensive. The traders making real money aren't the ones posting screenshots of their biggest winners on social media. They're the ones quietly grinding out consistent returns month after month, year after year, year after year. The math is brutal, but it's also liberating. Because once you understand why 90% of traders fail, you realize that avoiding their mistakes puts you ahead of almost everyone else in this game. You don't need to be a genius. You don't need insider information. You don't need perfect timing. You just need to do what most people won't do. Control your position sizing so no single trade can destroy you. Cut your losses quickly and let your winners run. Wait patiently for high probability setups instead of trading out of boredom. Accept being wrong without taking it personally. Treat trading like the business it is, not the casino most people turn it into. These aren't secrets. They're not complicated, but they're incredibly difficult to execute consistently because they require you to act against every instinct your brain has developed over millions of years of evolution. The successful 10% have learned to do exactly that. They've trained themselves to be comfortable with uncertainty, disciplined in the face of opportunity, and emotionless when money is on the line. The choice is yours. You can join the 90% who let their emotions and ego drive their decisions, or you can commit to the boring, disciplined approach that actually works. The market doesn't care which path you choose, but your bank account definitely will. The traders who make it aren't the smartest ones in the room. They're simply the ones who refuse to quit learning, refuse to stop improving, and refuse to let temporary setbacks define their future. That's the real edge in trading. Everything else is just noise.